Hi.
Good.
I think we might have Ryan Detrick here.
Do we have Ryan
okay,
Detrick
good,
on the line?
Okay, making sure. Ryan's here.
Ryan, we got you live on the air right now. You snuck in on us. Dennis Dick here. How you doing?
Okay, good. I was calling you guys, so that's why I didn't answer properly. I'm just trying to make sure we're good. I'm good. I'm glad to be on the line with you guys. Glad to be back.
Okay,
awesome.
Hey, Ryan, I just want to go right into the Quad Witch that we have coming up on Friday, and you sent me some notes here, and you say September is a very bearish month, but it turns out this week may be bullish. So let's talk about what kind of information you have for us, and perhaps give us a little insight into Friday's activity.
That's right, Dennis. I mean, Joel, my bad. Joel, that's right, Joel. When you get right into it, I mean, we all know September historically is one of the most bearish months, and that's factual. But, I mean, this week is options expiration, like you just mentioned, Quad Witching, options expiration week. And I like to always dive in a little bit with options expiration week. And historically speaking, I've noticed you get a little more volatility during options week, and they tend to also go the trend of the overall market. So really, since 2009, they've been bullish markets. This week has. And a neat thing about September that really shocked me when I dove in, the last 10 years, the week of September options expiration, so this week, is actually the strongest out of all 12 months. Up over 1.5% on average, up 8 out of the last 10 times, 8 out of the last 10 years. So that right there is kind of interesting because usually September's weak. But then a bigger picture look over the last year, options expiration week is up 9 out of 10 or 9 out of the last 12 times. And, really strong performance, again, over 1% on average. So what I'm getting at is September historically strong this week. This week historically is strong when you look at, over the last year or so. Yeah, last week, we're up 5 weeks in a row, down last week. But, people kind of concerned. But, hey, historically speaking, this week, whatever it's worth, is looking pretty bullish to me on a historical basis.
So are you looking at this potential pullback here the last few days as a potential to buy the dip?
I really think so. I mean, look at just last night on Twitter, when the futures opened. I mean, there was a lot of panic, it seemed like, at least what I was looking at. S&P down 6-7 handles, everybody worried about continuation from Friday. And that's one common trait that we've seen when we've had these pullbacks is everybody kind of panics. Now, one interesting study that I just did, and I know a lot of people have been talking about, we just had the first half of this month, one of the more boring, I guess we call it, 10 trading days. We didn't have really any intraday volatility. So I did a study that kind of looked from the high to the low on the S&P over a 10-day period and then compared it to really since 1970. And what I found was we recently, ending on September 8th, so about a week ago, we had one of the least volatile 10 days since August of 1993. So, now what does that mean? Okay, we're not moving, so what's it mean? Well, I looked, and at least what I found, it's usually pretty bullish. I mean, not too surprising. Usually not a lot of volatility is good. And I found, 18 times we had previous times of 10 days without a lot of volatility like we just saw. A month later, up about 72% of the time, up over 1% of the time. 6 months later, up 7% of the time, or up 7% on average, up 83% of the time. So, I mean, there's lots of different ways we can slice and dice this market, I'm aware. But to me, usually tops do have a lot more volatility than we're seeing right now. So my take is I still think, kind of buying, I guess you say you're buying a dip. It's continued to work. Until it doesn't, I'd still be in that camp.
Okay, that's a great point that you made there. I mean, you had the rollover last week from the September to the December contract, so a little jockeying position going, ahead of that. I see another thing that you're looking at is the presidential cycle, and your note was looking at the 4-year presidential cycle. We are in the worst 6 months of it.
That's correct. When we all talk about the presidential cycle, the 4 years, and if you look, everyone knows November to April is usually strong, May to October is usually weak. Now, when you dig in, the May to October of the second year is where we currently sit right now. Obviously, we're in September, so we're near the end of it. But I went back since 1950. And there's been 16 cycles, of every 4 years, so 16 cycles. The May to October period of the second year is the only 6-month period that's actually negative. All those other 6-month periods, 2 in the first year, 2 in the third year, 2 in the fourth year, all have at least a positive return on average. So historically speaking, we're in the worst 6 months. So, I think we're holding our own when you consider that. Now, the good news from that point of view is once we get to November, the November to April period, and I looked at those. I consider that the third year of the presidential cycle. You could say, well, Ryan, November technically still in the second year, and I would agree, but you have to make a cutoff somewhere. So because April ends in the third year, what I'm getting at is the 16 times we've got a November to April period during the third year of the presidential cycle, which again starts just this November. It's been higher, incredibly, every single time, 16 out of 16 times for an average return of 16%. So, I was pretty fascinated by that. We all, and then again, you can look at the stats. Just the third year of the presidential cycle, on average, is the strongest by far. But from a 6-month cycle period, we are getting into the most bullish months, guys. Hands down, from September all the way until about March. We've got some really, really nice returns on a 4-year cycle, presidential cycle basis. So, yeah, the next month or 6 weeks or so, sure, historically a dip makes sense, and we do have some little weakness out there. But to me, just to blindly say we're up a lot, let's be bearish here, you're totally ignoring cycle work, and the presidential cycle is saying, the bulls probably, when we look back 7 months from now, I would say history would say also will probably be higher, and I think that's still the case.
And you just got the S&P futures back to unchanged there with your bullish comments there. We just ticked 76, 75.
Ryan Detrick rally right there.
Yeah, the Ryan Detrick put a little RD on there as the Charles Schwab traders are bidding up the S&P futures. All kidding aside here, you do work in a lot of different areas, not only from the technicals, the options volatility, historical price patterns, but you also like to follow the sentiment polls, and they're showing a lot of optimism here, which could be a bad thing.
Right.
But your note was investors aren't exactly doing the same. We've had 5 straight monthly outflows on domestic mutual funds for the first time since late 2012, and we all know what the market did after that.
That's right. Yes, the sentiment polls, the investor intelligence poll just had, under 14% bears for the first time since 87, so the lowest number of bears since 87. The investor intelligence, or the AAII poll, just had a 50% bulls, 2 weeks ago, and that's pretty rare. That's pretty high also. So, people are saying one thing, but then you kind of look at the domestic equity flows, at least from the ICI data, and again, like you said, we've had 5 straight months of outflows. Now, I'm aware that a lot of those money, when you look, they're leaving domestic equity mutual funds, and they're putting it into ETFs. So it's not truly this bearish play, but just a bigger perspective. My take there is it still kind of shows this distrust of Wall Street. I don't think is gone by any measure. And just, that's, I still think that's kind of a bullish thing. And again, since 2007, we've consistently seen domestic equity, equity fund flows, outflows. And we've obviously had, we had the crisis, but then again, since 2009, we've had higher prices. So to me, it's still kind of a bullish sign, I think. That, the market's up for the year. I guess small caps are flat to negative, but most mutual funds are positive. Yet we've had outflows overall. So I find that still kind of a bullish, contrarian thing. And again, it does run 100% counter to what people are saying in the sentiment polls, where they're so bullish, and with their money, they're still taking it out of mutual funds and still a little cautious, I think. Again, just look at Twitter last night. You had a little pullback and the futures opened, and it really seemed like a lot of fear, and that's one consistent thing we've seen every 4 or 5% pullback. The people do seem to panic a lot more than they used to.
What are your stock picks? If you're bullish here going forward, Ryan, do you have some individual picks for us, a couple stocks that you like?
Sure. Well, when you get down to it, it isn't anything too new. I've liked big cap technology for a while. I still say avoid small caps. I think small caps had their big, generational peak back in March when they got extremely overbought. But I wrote about that then, and I still think big blue chips, boring blue chips, are the way to go, potentially for years. So just a QQQ, it's right at 100. It's kind of neat how it's pinned at 100. It's going sideways. It's not going down. So I really like that. And honestly, steel's another one that I've liked for a while. U.S. Steel. I mean, it hasn't pulled back. You know, it's that gap higher. And when you look at some of the, you know, no one trusts the data out of China, but, you know, Chinese stock market's done pretty well all of a sudden, and there is some correlation with steel. So I think U.S. steel still looks pretty good. And just from a bigger, almost boring play, QQQ, stick with those big cap tech names. They've done well for a while, and I still think that's kind of the best play, potentially for years, as people get out of small caps and kind of go back to the boring blue chip names.
Just going back real quickly, Rob Hood is talking about the amazing numbers during the presidential cycle. So just let's go a little forward looking here. Can you clarify the upcoming cycle now from September of 2014 through March of next year?
Sure. Well, yeah, exactly. What I did, if you start in September, so the 6 months is September to February. The 16 times that this has happened since 1950, what my work showed was the S&P is up 13.25% on average and higher 88% of the time. The October, if you start in October to March, so again, that'll be, you know, when October starts up here in a couple weeks, 16 times, up 16% on average, up 94% of the time. Now, when it gets really, really good, from November to April, so in a couple months here, the 16 cycles, it's up 16.33% average, up again 100% of the time, so all 16 times. So, you know, now just for comparison's sake, let me just pick a random one here. This is obviously over, but if you would have been in the second year from August to January, that actually had a negative return. On average, this has 17 cycles. So that's a negative return. So, you know, a while back, a year ago in August, that's when you didn't want to be buying. Now you could say, well, the market's done great since then, and I would agree. So it's not always perfect by any means. But just from a bigger cycle point of view, these next 6-7 months going out are by far the best returns on the 4-year cycle. Hope that cleared it up a little bit.
No, you did. Ryan Detrick, independent trader and market technician, following everything you want to follow in the market, sentiment, options ratios, covering it all. Brian, thanks a lot for coming on, and as always, we'd love to have you back again.
Great. Glad we got to connect, guys. Have a good morning, a good week, and I'll be back soon. Thank you.
Thanks, Ryan.